Jeff and I are going to say a few words, and then we'll take questions. We're going to cover, what's been happening in the public markets over the last few weeks and really the last 6 months, how that's translating to what's happening in venture markets. I'm going to take those first two sections, and then Jeff's going to talk about, we've seen this movie before, what it looks like, and what you guys can do about it. In terms of what's happening in the public markets, in terms of underlying causes, don't want to spend too much time on macroeconomics, but just so everyone understands why you've seen this huge downturn in the stock market that really began all the way in November of last year. Basically, starting last summer, we started getting inflation prints as measured by CPI that were really high. So if you go back to last summer, there was this huge shock inflation report that inflation was over 5% suddenly. It's been 2.5% for many, many years. And so all of a sudden, inflation reared its head after seeming to be a non-factor for a long time. By the end of the year, it was about 8%. You saw just a few days ago, there was another report that inflation was at 8.3%. And so it keeps hitting new highs. And you can see that in the red line on this chart that, this chart goes all the way back to 1954. But if you look since 2020 at the far right edge of the chart, you can see that inflation has spiked all the way up to 8%. The purple line represents the Fed funds rate, which is basically the interest rate that the Fed sets. And you can see that the Fed funds rate tracks inflation very closely because the Fed's mission is to combat inflation. And so what it does is it raises the Fed funds rate to reduce inflation. And that historically has worked, but it does require the Fed to raise interest rates. You can see here that CPI and the Fed funds rate have gotten wildly out of sync with each other. The Fed waited way too long to react to inflation. And as a result, the expectation now is that the Fed fund rate may have to move up substantially. They've already moved it up to about 1%. It was at 0 after the great financial crisis of 2008, but recently it's up to about 1%, but with an expectation that there may have to be a lot more. And you can see just the other day, Powell, who's the Fed chair, finally came out and admitted that they were slow in reacting to inflation. He basically said that he's willing to do whatever it takes to stop inflation, even if it hurts the economy. Basically, even if it means there's no soft landing, meaning that even if it means there's a recession, he's committed to stopping inflation. So, you're going to see more pain ahead in terms of interest rates increasing. And you can see this already in the 10-year Treasury, which is traded on the open market. The Fed doesn't set this interest rate. It's really set by markets. And you can see that the 10-year T-bill, the interest rate has basically gone from 0.5% during COVID to over 3% today. So the markets are already adjusting very rapidly. Now, I think one thing to understand about this is that the anomalous period is not now in terms of interest rates. The anomalous period was basically after COVID hit. So in the early months of 2020, in response to COVID, the Fed basically slashed interest rates to 0. And so rates went down for a period of a couple of years. The Fed had this zero interest rate policy, or ZIRP, and as a result of that, people started to believe that interest rates would be extremely low forever. But the anomalous period was sort of this 2020 to 2022 period where rates were extremely low. What's really happened is rates have gone back to something more normal, and they could still increase quite a bit more. The bad news for stocks is that they generally move in the opposite direction as interest rates. And you can see it here. There's a very obvious inverse correlation here between, say, the S&P 500 and the 10-year Treasury yield. This would also be true for the NASDAQ, even more extreme. Basically, all stocks get hurt by rising interest rates, but the long dated stocks, the stocks that have their earnings and revenue in the distant future, get hurt the most, because the higher interest rate means that those future earnings and revenue get discounted down to a lower number today. So even companies that are hitting all of their revenue and earnings targets, if they're growth companies, they go down relatively more than value companies. And so that's basically what's been happening in the markets, is that growth stocks have been getting the hardest. The Dow Jones, the NASDAQ, and the S&P are all down, but it's the NASDAQ that's down by far the most. And then within the NASDAQ, it's been all the growth stocks, especially the recent IPOs, the newer listings, the SPACs. The more growth oriented they are, the more they've gone down over the last 6 months. And a lot of the carnage has been hidden by the fact that if you just look at the indices, the indices are so weighted to the large caps, like the NASDAQ is just weighted to, the Googles and Microsofts, Amazon, and so forth, and they're down, but they're not nearly down as much as growth stocks. So just to give you some examples, this was done as of last night. A firm is down 89% off its 52-week high. Asana, and I'd say many software SaaS companies down 86%. Shopify and Zoom are down 79%. Zoom is lower today than it was before the pandemic, which is pretty stunning. You think about how much Zoom grew during the pandemic. It's now valued lower than it was in early 2020. Monday, like Asana, down 78%. Toast, DocuSign, Twilio. And then even the very best SaaS companies, companies like Okta and Snowflake, which are growing very fast, do billions of revenue, very strong franchises, down 68, 65%. So all of this is due to the fact that, valuation multiples are compressing because interest rates have gone up significantly. Today, there was a bounce in the stock market. And, so for example, a firm was up 30%. That's good to see. Hopefully that's a bottom, but it doesn't change this analysis. And the reason why is, if your stock is off 90% and then you get a 30% bounce, all that means is that instead of losing 90%, you've now lost 87%. So it takes a much bigger increase after a loss to get back to where you were. And I should just note that generally speaking, all these companies are doing quite well. They are reporting significant revenue growth. There have not been giant misses. Most of them are growing very strongly. They're doing well. It's just that the market is now choosing to value growth stocks in a fundamentally different way. And you can see that here. So this is just for the SaaS index. And the chart goes back 5 years. You can see, let's see, how do we get the, well, I'm gonna tell you what some of these numbers are. Okay, so you can see here, this is the multiples, the valuation multiples that the public markets have put on SaaS companies. And it's broken the companies out by basically whether they're high, medium, or low growth. And then the blue line is sort of the average of the whole category. And you can see that if you go back 5 years, these averages were, these companies were trading at, roughly 5 to 7 times ARR. This is enterprise value divided by next 12 months revenue, which is sort of close to ARR. But during the pandemic, because of the zero interest rate policy and the belief that interest rates would stay low forever, these companies went, the ARR multiples went through the roof. And you can see that, especially for the high growth companies, they went from, roughly 5 times all the way up to as high as 35 times during the pandemic. They have come all the way down back to the high growth now is about 8 times. And then the average is about 5.6. So the average during the pandemic was about 15 times. So it's gone from 15 to 5.6. So you're talking about roughly a 2/3 correction in the valuation multiple that's applied to these public companies. Let me just see if I can, okay, for some reason. we can get you those exact numbers. So I thought this was a good tweet by Matt Turk. So just to put the depth of the reset in context, to justify a $1 billion valuation, a cloud unicorn would need to plan on doing 178 million in revenues in the next 12 months if you were to apply the current median cloud software multiple. So again, the current multiple that the public markets are putting on SaaS companies is a 5.6 times forward revenue. So now that's for the median SaaS company, which is growing about 20%. If you were growing 40%, this number would be closer to 8 times, but it's still, way down from, where it was before. So again, the average has gone from 15 to 5.6. The high growths have gone from 35 to 7 to 8, something in that range. So you can see now just how incredibly hard it is to justify even like a single-digit unicorn valuation if you're to use the public comps. You'd have to do, again, if you're growing at the average, you would need to do 178 million in revenue. If you're growing faster than that, you can sort of discount it down, but this is sort of the new reality. And you saw Jason Lemkin had a tweet that sort of shows the implications of this. He said, if nothing else, expect a fraction of the new SaaS unicorns we saw in 2021. With so many amazing public SaaS companies now worth just 2 billion, you really, really got to be epic to be worth 1 billion. So, what he's saying is there are public SaaS companies that are doing hundreds of millions of ARR that are only worth, say, 2 billion. So, how many startups actually get into the hundreds of millions of ARR? You have to believe that to be the case, and you're going to have to get a lot closer to delivering those actual numbers in order to be worth, in order to have unicorn status in the coming years. So that's what's been happening in the public markets. This has been a fundamental valuation reset of all growth companies and then also SaaS companies in particular. How does this trickle down into venture markets? Well, there's 3 ways. So number one, VCs take their cues from the public comps. Those are the exit prices for VCs, right? So VCs know that a company that used to have a $10 billion unicorn outcome or decacorn outcome is now only worth, say, 3 billion, then they can't pay the same prices they were paying before. And that does trickle all the way down to the Series A stage. The second reason is that liquidity has left the venture ecosystem. There's just a lot less capital available to invest. I'm going to speak to that in a second. And then third, you're seeing many firms are frozen in the market while they're awaiting clarity. We're not, but a lot of VC firms are basically just risk off. They're just not investing right now. And the reason is there's just so much uncertainty. You have the uncertainty in the economy. There could be a very severe recession coming. You've got the geopolitical uncertainty of this war, and does it escalate and spin out of control? And then, of course, you just have the fact that the markets have adjusted so rapidly that a lot of VC firms are awaiting clarity on where the new valuation levels are going to land. So for all of those reasons, venture markets basically have followed the same trajectory as the public markets. And you can see this in terms of the liquidity effect, that the crossover investors are basically out of market. They're either temporarily gone or gone forever. If you think about like where the liquidity over the last couple of years in venture came from, it's true that VC firms had bigger funds, but also, and they were deploying them faster, but also you had these huge crossover investors who were public market investors who had come into the venture space thinking there was an arbitrage. They were looking at the public comps and seeing, oh, wait, if we invest in the last couple of private rounds, we can eventually, there's a huge spread between public and private valuations. And so they bid up all the private valuations based on the public comps. Unfortunately, those public comps were inflated. So you would think, okay, well, don't these guys have huge funds that were already raised recently that they can still deploy? And there's a really stunning article in TechCrunch just a few days ago saying that even Tiger, which just raised a massive new $12.7 billion fund, they didn't even announce this till March of this year. I think it was largely raised in September of last year. They even deployed that fund. It's gone already, something like 65% deployed. So even these huge funds that were raised and announced in the last year, because the pace of deployment was so high, a lot of that money is gone. And then of course the VC funds who still have funds, they're slowing their pace of deployment. They're going from 1 year pace of deployment to more like 2 or 3. Even if the same amount of capital was available in the ecosystem, if VCs just slow their deployment from 1 year to 3, you're looking at a 2/3 annualized reduction in the amount of capital available. You already started to see this in Q1. In Q1, venture funding dropped 20%, and Q1 really wasn't that bad. I mean, the market was in the process of going down, but it had not hit the levels it's at today. There was not sort of a panic. And yet, even because of what was happening in the markets in Q1, VC funding was down 20%. I think in Q2, it'll fall off a cliff, and you'll see something similar in Q3 and Q4. Again, just showing that this doesn't just apply to growth funding. It goes all the way down to the early stages. Obviously, if the first thing to happen is the growth investors reduce their valuations because they're looking at exits that have much lower valuations. But then the Series A investors have to look at what growth funds are paying to mark up their deals in a couple of years. And if those prices are way down, then early stage VCs have to pay less as well. And you've already seen just in Q1 again, Series A deals were off from 26.69 to 23.64. And again, you'll continue to see more of this. So just like what I was saying, Q2 expect will be, also the nuclear winter slide. Don't want to be overly dramatic, but funding pace of deployment is going to fall off a cliff. All right, let me kick it to Jeff to talk about the next steps here.
Okay, great. Thanks, David. So I'm going to share my screen now. Here we go. All right. Whoops. Okay, everybody can see that?
Yep.
Great. Okay. So we've been here before. This is not unprecedented. Go through a little bit of historical context here. So the last two, kind of major recessionary periods were the dot-com crash of 2000, 2002. This one lasted about 2.5 to 3 years. It was really driven by this excessive speculation of internet companies, really fueled by the bull market of the late 90s. There was an abundance of venture capital. At the time, all these companies were being valued off of eyeballs. How many eyeballs did companies have was sort of the metric. Didn't matter how much revenue you had or profit, but it just mattered how many eyeballs. When the market corrected in April of 2000, it was sort of the beginning of like I said, 2 to 3 year period of sharp declines in the stock market and also mass layoffs and bankruptcies and companies that sort of were going out of business, including companies that went public. So, several public companies folded at that time period. It was pretty dramatic. And it was very tech and internet focused. We also then had the Great Recession of 2008 and 9. This one lasted about 1.5 to 2 years. This was really an asset bubble that was concentrated in the real estate market and the housing market, driven by sort of overly aggressive lending and mortgages. It kind of cratered the whole economy. The interesting thing about this one is that it actually didn't affect the tech sector as much as some of the other sectors. So now we have, this current crisis, which we believe is, the beginning of a recession and the next kind of significant down period, 2022 to, or maybe we'll even say it started in 21, but as we look back, in retrospect, but when it ends, we're not sure yet. We think it'll be at least, 1.5 to 2 years. And this one's also largely being driven by sort of tech and growth, companies. We had sort of inflated valuations driven by 10 years of very low interest rates. And now this correction is being caused by this expectation, as David described, of higher interest rates. And inflation obviously being a big input there. The one thing I would say about this most recent downturn is it feels a little bit more like the 2000 to 2001 internet bubble bursting, because again, it's very tech centric. So kind of in the work that we all do, in the types of companies that you're all building, and in the venture capital space, it feels a little bit more similar to the 2000 and 2002 downturn. This is just sort of, these are the types of headlines that we saw back then. You can see here this chart of the sort of rise and fall of the market. .com bubble bursting, companies sort of, having, struggling. The dot bomb was one of the terms that people were using back at the time, or the bubble bursting. And we even had this site called Fucked Company back then, where every day you would sort of go to Fucked Company and you would see different companies that were either doing big layoffs or shutting down, or had other problems. I think the real silver lining of this time period is that there were some amazing companies built, either that were started right before this time period or even started during this time period, including companies like PayPal, Amazon, Salesforce, Google. Those companies all started either right before the kind of 2000 .com bubble burst, or even, in some cases during the downturn. So, okay, what can you guys all do about this? I think the good news is there's a lot you can do about it. You can control your own destiny, and you really have the ability to, we're early enough in this kind of period that there are things you can do today to kind of, help position yourselves for success in the next couple of years. The funding markets are definitely tighter, but they're not gone completely, so that the bar is higher, but it's still possible. These are some metrics that we've laid out: growth metrics, gross margins, net dollar retention, CAC payback, burn multiple, that we think are sort of great, good, and danger zone. So growth, if you're growing, 3X, that's great. If you're growing 2.5X, that's good. If you're under 2X, that starts to be in the danger zone. Gross margins of 70% are great. 50% is good. Under 20%, the danger zone. Net dollar retention, 140% is great. 120% is good. Under 100%, is the danger zone. Your CAC payback, 6 to 12 months, great. 12 to 18, good. Over 24 months, in the danger zone. And then again, burn multiple, 1 or less is great. 1 to 1.5 is good. The danger zone is over 2. If you haven't read David's blog post on the burn multiple, I would encourage you to check it out. There's a great blog post back to 2020, I believe, about this concept of burn multiple, way before anybody was, talking about being capital efficient. And so that's definitely something to pay attention to. In the market we're in right now, you really have to sort of be in this kind of great column to attract capital. And then the only other thing I would say is, as it relates to growth and capital efficiency, if you have the option to not raise capital by growing a little slower, so if you can extend, if you have the option of saying, having a year of runway at a 3X growth rate versus having 2 years of runway at a 2X growth rate, I would say that extending your runway trumps growth rate right now, and I would choose that second option, because the best scenario here is to not have to raise capital at all. And really, this slide is about what you need to do if you do need to raise capital. All right, next slide here. So, things to think about that are in your control, that you could be, doing now. If you do, top up if possible. If you do have that option to raise more capital, be open to lower valuations. If there were investors that were interested in your last round that didn't get their full allocation, or didn't get an allocation at all, those might be folks who may be interested in putting some money in. There are adjustments now that you can make to have 30 plus months of runway. We thought about what the right amount of runway is, and we were thinking 24, but the problem with 24 months of runway is that if you really need to raise capital about 9 months before you run out of runway. 6 months is pretty tight because it doesn't give you an opportunity to course correct if that fundraise doesn't go well. So the advantage of 30 months of runway is that you can, so to finish the 24 months point, if you have to start at 9 months before you run out of runway, that means you have to start in 15 months. And the problem with raising in 15 months is that that's like just barely over a year from now. And our view is that this market could still be pretty choppy, 15 months from now. So really, looking at 30 months of runway is, I think, a better a better goal for folks to have. And, and if you don't have that, maybe it's a good idea to try to raise, or if you can make some minor modifications, whether that's, modify your hiring plans, consider a hiring freeze. You can have a hiring freeze and still hire a few of the kind of key crucial roles, but generally have a hiring freeze across the company. And also think about trimming any sales and marketing spend that is not, immediately measurable and has a near-term ROI. So those are some of the things that we would recommend thinking about to try to extend your runway to 30 months or as close to it as possible. Aim for a burn multiple of 2 or lower. And I think, acting fast, the sooner people act, especially in things like cutting burn, the more impact it has, because the less cash you've burned waiting. And I think the good news, just to leave everybody on a positive note, and then we'll open it up to Q&A, is, again, as I touched on before, some of the most iconic companies have been built in these times. It's actually a great time to build a company in a lot of ways, because the one thing that's harder is access to capital, but actually a lot of other things get easier. You have an easier time hiring people. That's been one of the most challenging things in the last 5 years as the market got really hot. But in these markets, it actually tends to be much easier to hire people. You start seeing companies doing layoffs. You see fewer companies aggressively hiring. So hiring does get easier. Marketing, customer acquisition sometimes gets easier because the competition in marketing spend. So things like, Google paid search or Facebook ads can sometimes be cheaper in these times. So, again, some of these companies like Google, Amazon, Salesforce, Airbnb, Stripe, PayPal were all built in these sort of tougher times. So, and I think, we companies have an opportunity to course correct, right? You can focus on the fundamentals. You can make some of these changes we talk about. It's still pretty early to be able to make those changes. We are super excited about, being in business with all of you. We think you can do it. We're here to help. The world will keep going. The world is not going to end. So we want to leave you on that, positive note. I know there's been a lot of negativity in the markets and on Twitter and in this presentation. So I think there's also a lot of stuff to be excited about. I think that's sort of the end of our prepared comments. So we will open it up to Q&A and kind of go from there.
Jeff, I've been I've been compiling a bunch of the questions. So let me just hit a few first. So one is, and Dave, you can comment on this too. There may be a misconception that the TLDR here is to get to break even ASAP. And maybe that's like a misunderstanding of what a 1 burn multiple is. So if you guys can comment on, are we saying that they need to get to break even, or what is the guidance here?
Well, if you can, that's amazing. I wouldn't discourage anyone who can operate in a cash flow positive way. I wouldn't discourage them from doing it, but that's a super high bar that I don't think most startups could get to. A burn multiple of 1 means that the amount of money you're burning equals your net new ARR. So, if in a given quarter you add $1 million of net new ARR, ideally your burn is not more than $1 million. Even that's pretty tough to do historically, but definitely doable. That's what efficiency looks like. I think the way to think about your spending is the first thing you have to do is honestly assess your eligibility to raise a new round in these conditions. And Jeff, can we throw up that slide again on like what great looks like?
Yeah, let me do it.
If you have great, I think this slide's really important.
Oh, I think I just went past it. There it is.
There it is. So if you have great metrics, I think you're gonna be able to raise. It may not be the valuation you want. I don't know what your valuation was last year and so forth, but you'll probably be able to raise. But if you're merely in the good column, you might have trouble. I mean, we're in kind of a nuclear winter. Now, if you're like great on 3 or 4 variables and good on 1 or 2, probably you can raise. But I would say just merely good numbers may not be good enough. So, and if you've got danger zone numbers, then I'd say that's a real problem. You're probably not going to be able to raise. So if you're in the danger zone, you have to fix those variables like ASAP. And the sooner you do it, the better off you're going to be. And the one that's probably most often for a lot of companies is going to be the burn rate, the burn multiple, the amount of money you're burning. So again, you got to be realistic about where you stand in relation to your ability to raise capital in this environment. And if you have a danger zone variable that's basically disqualifying your future funding, you need to give yourself adequate time to fix that. And like Jeff said, adequate time really is more like 2.5 years, not even just 2 years, because again, you got to go out and raise before you run out of money. So even if you had 2 years of runway, that doesn't give you 2 years to fix your company. It gives you maybe 1.5 years. So giving yourself the time to address all the issues in your business is the most important thing you can do right now to make sure you survive. Don't wait to take the hard steps, because the sooner you rationalize your burn, the more money you have in the bank on the other side of that decision. Sometimes people will leave it way too late. I mean, they'll say, okay, if we don't hit this or that number, we'll make changes in 6 months or a year. The problem is, a year later, now you're down to 12 months of runway, and then you make the decision and you buy yourself a little bit more time. But if you had made that decision a year before, you could have had 3 years of runway. Now you only get, 1.5 years or whatever it is. So just the luxury of time. It's the greatest luxury you can have as a startup, is the time to make all the changes in your business that you need.
There's a bunch of questions about how this applies to marketplace businesses that, Jeff, you should touch on. But before we do that, there's a few other follow-up questions to this point. One is, if everyone takes this advice, does that imply that getting new and more budget, so selling, is going to get harder?
I think it's a great point. And so I would say, yeah, that's definitely a possibility. And it kind of depends on your exposure. So here's what's in the process of happening, is that until now, for like the first 4 months of the year, the stock market correction was mainly driven by valuation multiples resetting back to their historical means, as opposed to this sort of anomalous COVID period. So it was driven by multiple compression. Most of the stocks were actually doing well in terms of revenue and earnings, except for a handful of COVID stocks. So this is not being driven by bad results. Now, we're in the process now of happening is going into recession, I think. And in the startup world, there's definitely going to be a recession, because everyone's hearing these signals, and they're basically going to reduce their burn. So we don't know what the impact yet is going to be of the recession. The impact to date's just been in multiples, not revenue. But yes, it could get harder to perform during the downturn. I don't think that's a great excuse for startups, by the way, because the market for your product, the addressable market for your product is so large that there should always be somebody to sell to. But there could be, yes, it could get a little bit harder.
Let me take that one about the marketplaces. So good question. I would say that the framework on this slide is sort of generally applicable to marketplaces with a couple of tweaks, and I'll kind of go through each one of these. So on the growth concept, I think it's pretty much applicable as the numbers are shown here. But as I said earlier, and I think this to me is both true with marketplaces and SaaS, the one thing I would say about growth in general is, this slide is about what you need to raise capital. It's even better to not have to raise capital. So if you can grow only 2x by extending runway to say 24 or 30 months versus growing 3x and need to raise in a year, I would say it's even better to just extend your runway to 24 or 30 months, even if you're only growing 2x, because that will allow you to not have to raise at all. So with that one caveat, I think this growth row applies to marketplaces as well. Gross margins, same thing. The only thing I would say on gross margins, which is important to think about in the context of marketplaces, is this is, the denominator here should be net revenue, not GMV or GTV. So some marketplaces, present their P&L where they've got sort of, a gross merchandise value, gross transaction value. Then they've got a net revenue, which is the take rate times that. So this would be the gross margins that are below net revenue net revenue minus those variable costs that get you to gross margin. So this would be the gross profit divided by the net revenue, not divided by GMV. So I know of a couple of marketplaces in our portfolio that have presentations slightly different from that. So that with that one caveat, I think these percentages are generally also true for marketplaces. The net dollar retention, I would say, is the one thing on here that's probably not relevant for marketplaces. Net dollar retention in this context is much more relevant for SaaS businesses, and we don't really see many marketplaces that have net dollar retention. Transactional driven marketplaces where there is no subscription. There's just kind of a transaction concept, and people come in and out to do transactions. There are high frequency marketplaces. There are lower frequency marketplaces, but even the high frequency marketplaces tend to, not hit these sort of metrics. So I would say that's the one row here that doesn't apply as much. CAC payback, very, very relevant. These CAC payback numbers, I would say, can be thought of with marketplace businesses. Generally, the way we think about CAC payback in the context of marketplaces is you take all your sales and marketing spend, and you divide it by usually the demand side participants that you acquire in a given period, and that's your CAC. And then your payback is your is based on the amount that the cohorted amount of gross profit that cohort of users provides over the period of 6 months, 12 months, 24 months, and you want to make sure you're getting that CAC paid back in ideally 6 to 12 months, as shown in the gray column here. And then burn multiple. The one burn multiple I think is very relevant. The one caveat is because SaaS businesses tend to just grow revenue, right? You don't really see healthy SaaS businesses that sort of shrink revenue month over month. Whereas in marketplaces and in transactional businesses, you can have months that are actually higher and then months that come down. Seasonality, oftentimes you'll see like Q4 and you'll see a spike in Q4. So you may have a year where there's trending up for sure, hopefully at this kind of 3x kind of multiple, but there could be months where it actually comes down. So because of that concept, you can't always look at burn multiple in a aperture of just 1 month, because you're actually going to have negative growth in a month sometimes. So sometimes you have to open up the aperture to look at a quarter or even a year of how much incremental annualized revenue did you generate, quarter over quarter or even year over year. And if you look at that annualized revenue growth, relative to the amount of burn you had, say, in that 1 quarter or 1 year, you should still be hitting these types of burn multiples. So it is also relevant with that one caveat. I think those are really the primary tweaks that I would make to the slide in the context of marketplaces.
Let me address a couple of these other questions about burn multiple. So when asked, you said that you should aim for a burn multiple of 2 or lower. Especially given probable customer softness, even if we're not seeing any yet. That probably calls for immediate layoffs at many companies, and that is correct. That is correct. If your burn multiple is above 2, you really, now, this is not necessarily true for seed and Series A. Let me just come back to that in a second. So if your burn multiple, let's say you're sort of at this you've already raised a Series A or Series B, and you're sort of in this growth stage, or your next round would be a growth round. The availability of growth capital has massively dried up, and you really need to have the great metrics. And even if you have great metrics, if the rule of thumb for deals last year was 100 times ARR. Now maybe it's 20. So, if you don't want a down round, you're going to need to grow 5x just to get a flat round. This is just sort of rough math. I mean, every case is different, but that's the rough math. So you've got to give yourself time to grow into your valuation. And so, yes, I mean, if you're in that situation and you don't have 30 months of runway, let's say, and your burn multiple is over 2, I would be cutting, Now, if you've got 3 years plus of runway because you raised so much money last year, we have a lot of companies who are in great shape because they raised a huge round from Tiger last year or one of these other growth funds. But I would just preserve that cash as much as you can, because the availability of growth capital is just fundamentally different now. And so it's wonderful if you made hay while the sun shines, but you should just realize the environment's different now. So if I were, under 2 years of runway or 2.5 years of runway and had a burn multiple above 2, I would be making cuts right away. At a minimum, I'd be freezing spending to grow into a burn rate that was more reasonable. But that, again, that would come down to how much runway I have right now. If I had like over 3 years of runway, I might be more okay just kind of freezing my cost structure, and maybe you don't have to cut. But if you're under 2 years, definitely. Now, Colin asked a question, how these numbers apply to a seed or Series A stage company. We still need to build and scale. So seed, burn multiple doesn't really work for pre-revenue companies, right? Because the denominator is net new ARR. So if you're pre-ARR, it doesn't even make sense. Similarly, if you're in the early stages of selling, your R&D is just, you're going to have a lot more product development expense than revenue. So it's okay in the earliest stages to have a higher burn multiple, but I would be looking then at just how much runway you have. And you need to be asking questions about, do I have enough runway to achieve the results that I'm going to need to raise the next round? So, at some point you have to make your burn multiple make sense. And the question is, can you get there, and can you raise money before you run out? And I would just say for these early stage companies, just stay as lean as possible. Your job is in those early stages to find product market fit. You don't necessarily need a ton of burn to do it. Anybody who doesn't really help you find product market fit, shouldn't be on the team yet. Just give yourself the maximum amount of runway. And remember that by the time you do raise your Series A round, the burn multiple then becomes important. So you need to be trending towards a burn multiple that makes sense, even if at, for example, the seed stage, it doesn't yet.
On that note, there's a lot of questions about more tactical advice on the types of customers that people should be pursuing. If you're selling to other startups, does that put you in a riskier position? If you have the ability to move up market, should you do that? Are there sectors that are less affected by this than others? Any comments on that topic?
Yeah, this is the Yahoo banner advertising problem. Is during the dot-com crash, it was believed that Yahoo was then the most valuable internet company in the world. And it was believed that it would be fairly insulated from the dot-com crash because it had plenty of cash and it was a public company and all that stuff. But it wasn't, because all of its customers were startups. And as all those startups ran out of money and died and started cutting costs, Yahoo's business basically dried up. So yeah, you do have to be aware of who your customer base is, and startups are the most exposure, then SMB second most. Enterprise customers generally are considered to be the best customers. Now, that being said, you have to pursue customers where you have product market fit. This isn't like your customer mix is not something you can change overnight. And in general, it's good to be able to move up market over time, but that takes time because you have to address product objections, and enterprise customers are more demanding and they have more complicated product requirements, and they generally want your product to be more comprehensive, and they have more complicated sales cycles. So the idea that you can just all of a sudden overnight change your customer mix from SMB to enterprise, I've seen companies try to do that forced march too quickly, and it doesn't work. So it's something you want to evolve towards if you can, but that was probably a business strategy anyway. But yes, if you have a significant startup exposure, you just want to watch that pretty carefully. What it may mean is that over the next 2 years, you have more churn more logo churn than you expected, not because your product is bad, but just because those companies are going out of business at an elevated rate.
Jeff, there's a question about, is the financing environment the same at the growth stage as the seed and Series A stage? Or is there's rumors going around that seed and A rounds are more insulated, still easier to get done?
Yeah, I think my view on this is that it's all affected by this downturn, and we're already seeing that. David shared the numbers earlier of just like VC dollars being put to work, and we've seen a dip in Q1, both in the growth, both overall and in the early stage, and I think we all believe that dip is going to come down even more in Q2. And it's going to be affecting the early stage as much as, kind of every other stage. I think it probably started in the growth stage, but it kind of gets kind of catches everywhere else as well. So, and I think we've already kind of crossed that chasm. So I think it's like, I think the narrative that this is only affecting growth stage and it's not affecting seed and A is like, that's not true.
Another interesting question.
Yeah, by the way, one of the ways that Series A's can be affected is that the bar goes up. I mean, not everyone here may remember this, but really, even just a few years ago, like when Craft started in 2017, and I remember the SaaS rules of thumb back in 2017, 2018, 2019. The rule of thumb was that you needed $1 million of ARR to raise your Series A, and Series B was like 4 to 5 million. And those rules kind of got thrown out the window over this last 2-year period during COVID, when everybody was basically gaslit by like 0 interest rates. They started to think that that's what the world would look like, is that all these future years, in 10 years, 20 years, you could basically start to put a value on them without a discount rate. In any event, the old rules were 1 in 5. So, in the last couple of years, you could raise a Series A with say $500,000 or 300,000. We were seeing people do, not us, but firms would do crazy Series A's that were pre-revenue. I think those days are kind of over as well. So you have to remember that you not only need time to, if you're a seed company, to find product market fit, you gotta have time now to start stacking enough revenue to meet those Series A criteria.
There's a question about acquisitions. So you both started companies, PayPal and StubHub, in downturns, and then you guys both went through acquisitions. Does the acquisition environment change in the same way that the funding environment is changing?
Yeah, it's hard to say how it's going to cut. I mean, look, if you're a company that's lost 80 to 90% of your market cap in the last few months, you're not going to want to use your stock to buy, in an acquisition. So there's going to be a chilling effect there. Maybe the big companies that have a lot of cash get back into the market, although they're somewhat stymied because of the regulatory environment in Washington. Is like, we have the toughest antitrust, policy coming out of Washington at the FTC that we've had in a long time. So I'd say probably the net of this is a chilling effect on M&A, maybe quite a bit. Yeah, I mean, yes, the problem is just that the companies who could buy you for cash and would like to do that, again, there might be somewhat stymied by Washington, whereas the companies that would buy you with stock are going to be less willing to do that with price. Now, eventually prices may return to some more normal level, and then maybe the M&A market picks back up. And of course, the exit prices will be a lot lower now too. So, we'll see what happens there. I don't want to overstate it. Jeff, what do you think?
I totally agree with that. I think M&A definitely will cool off. Companies when acquirers get excited about doing M&A when times are good, when their stock prices are high, when they have a currency and a stock price that they can use to do the acquisition. And that's not the case right now. And I think just in general, even big companies, publicly traded companies, I think and even companies with lots of cash, looking at this environment, I think are also being more cautious and less aggressive. And I think M&A tends to happen when when people are more aggressive.
Yeah. So Stevie has an interesting point here. What happens when founders don't want to raise money at current prices? Good companies with strong fundamentals won't raise. Adverse selection problem with those raising. Funds need to deploy capital. Will this have an upward pressure on valuation in order to find the actual more clear prices for private finance and good companies? So it's true that right now, part of what's happening in the market is that if you're a founder and you don't need to raise, you're not out there raising. I mean, it's a terrible environment, right? So this is one of the reasons why you'll see in Q2 a huge fall off in the number of deals, is that if you could raise last year, especially in the second half of last year, you probably did. So there aren't like as many companies that need to fundraise right now. And so if it's optional for you, you're probably not doing it. But what you're going to see is towards the end of this year, and certainly going into next year, there's going to be more and more companies that can't wait anymore, and they're going to be forced to raise. And then we're going to get a lot more data points on valuations. And the new price levels will sort of completely gel, because founders won't be able to resist those levels anymore. I think we already kind of know where they're going to be, but yeah, you're going to get a lot more data points later in this year. In terms of, is there pressure on VCs to deploy capital? You just have to remember that the pace of deployment over the last couple of years was the anomaly. So, these 1 year pace of deployments in these funds, that's going to slow way down. 2 years plus used to be the old pace of deployment. So even funds that have capital are going to be deploying it more slowly. Also, there are going to be a lot of new VCs in the market who simply can't raise new funds. LPs their portfolios have been hammered too, and they may be allocating less money to VC in the next year or two, and they may be getting more selective about which managers they're going to choose. And then, of course, finally, like I said, the amount of crossover money from non-traditional investors, that's going away completely. So there will be a lot less money coming into the ecosystem over the next 2 years, and it's going to be deployed more slowly. So yes, we're in the job, VCs are in the job putting money to work, but they're going to be much more selective about it over the next 2 to 3 years.
And the only other thing I would add to that, and I think we might have touched on this earlier in the slides, is there's a narrative about how like all this money's been raised by VCs in the past couple of years, and so it's there, it needs to be deployed, and that's partly true. But the piece of that is you got to remember is because the pace of deployment in 2020 and 2021 was so fast that even if you raised a fund, even in 2021, many of those funds are 50, 60, 70% deployed already. And the remaining 30 or 40% is reserves for the portfolio companies, especially at the earlier stage where funds, keep reserves for existing portfolio companies. And if anything, the funds want to keep more reserves right now because they're looking at this environment saying they need more reserves for their existing portfolio companies. So there may be less money than people think that's already been raised. So part of it has to, in order for there to be more venture capital, it needs to be raised in the future, which is going to be more challenging for some newer venture firms.
Yeah, I mean, remember that slide on Tiger? They have $12 billion fund that they just announced in March. It's already gone. And we have a bunch of companies that raise growth rounds from Tiger. So God bless you. But I mean, those giant Tiger rounds were a beautiful thing, but you can't assume that the money that they're going to be there in the future. By the way, there's a lot. One of the objections that you always hear when VCs talk this way is you guys are just talking your book. You want prices to be lower, all that kind of stuff. I think it's important to understand here that the market really sets the prices and valuation levels in good times or bad times. We're price takers. The market sets, we just choose who we want to be in business with. And our only motivation here in doing this call today is making sure our portfolio companies survive. We do not want you to go bankrupt. That's 100% of our motivation, and reacting to the new realities on the ground as quickly as possible. And I think VCs, this is one area where I think we are better positioned than founders to see what's happening, because we are in the market for capital every day, whereas you guys kind of only, poke your heads up every year or two as you need money. So, we're telling you what's happening, and you can read similar things online from other people who are in the capital markets. But our goal here is just to give you guys the information. Obviously, it's your companies, you run them, but giving you the information so that you can adapt as quickly as possible and then, survive this downturn.
Okay, one related point to end on, since we only got one more minute. There's kind of this implication that Q2 is going to be rough and that maybe this is going to last for 2 years. What are some of the leading indicators that will know we're making our way out of this period?
Well, I think you want to pay attention to, at the macroeconomic level, interest rates are going to matter a lot and inflation is going to matter a lot. So, and then, you can look at like stock market prices and valuation levels. You can look, so, I mean, in the same way that the VC market took its cues from the public markets on the way down, they will take their cues from it on the way up as well. Remember, we still have a recession that's likely coming in the next 6 months. So we got to, there could be more shoes to drop here.
And I would only add to that, GDP growth, company revenue and public company revenue and earnings. We'll probably see, GDP growth be negative again in Q2, maybe beyond Q2. And as that starts to recover and start to be positive again, as well as, just companies, P&L. And there'll be some bellwether companies that I think will start to sort of show the performance of the broader economy.
Okay, we're at time. This was great. David, Jeff, thank you. And we'll follow up with everybody. Thanks for joining. Hopefully this was helpful. And everybody at Craft wants to be helpful in this time. So make sure to talk to your point of contact or anybody else on the team.
Yeah, and actually the only other thing I want to add to that about the Craft being helpful is, we do have a large platform team now, including people that can be helpful in lots of these different types of questions, including things like layoffs. So, if you have any questions about that or want our input, we can certainly, connect the dots on that and try to be helpful there.
Great. Okay, that's it. Thanks, everybody.
Thank you.